We start off with a fueled-up rally. Crude oil crossing the $80 mark for the first time since 2014. WTI is now up 7 weeks in a row, its longest winning streak of the year. That helped the energy sector lead the way in today's market. 9 of the 10 top-performing S&P stocks today were in the oil space. The sector overall up 50% this year, making it the best performer so far. So will the energy rally continue, or is this red-hot trade running on empty? Brian Kelly, what do you make of this huge run?
Yeah, well, so listen, I've been long of oil, and so you're kind of asking a barber if you need a haircut. I would say yes. I do think oil has more to run, but there are some fundamental reasons behind this. We know that there has been underinvestment in the traditional carbon-based energy sources, so natural gas, drilling, oil drilling, those type of things. Those are slow to react. And it's unclear whether or not we're going to be able to have the typical supply response that we might get in this particular situation. So I do think that higher energy prices are here to stay. That being said, we've had a pretty good run here. I did take a little bit of profit today. That doesn't mean I think it's going down, but I do think that higher energy prices are going to be a part of this winter at the very least, and maybe into the summer.
You know, in the past, one might think about demand destruction, a point at which the price of oil, the price of energy is so high that it starts to curb usage of oil. Nadine, are we just in a completely different backdrop economically today where that term doesn't even come into effect for a long time?
Mel, I think you're making a good point. You know, BK talked about the supply dynamics. You're talking about demand. And as we're reopening, you're seeing the COVID numbers come down. That's just going to further, I guess, put fuel on the fire, to have a bad analogy here. So what we actually think is, you look at that and the macro setup, you're seeing a reflation going on. You're seeing the growth of GDP accelerating, the growth of inflation accelerating. It's no wonder why energy and financials are doing well. So we think you can hold on to these energy names. Obviously, we've had a lot of final trades, BP, Shell. So we agree with BK. You can hold on to these, but it doesn't mean you can't trade them. It's, you know, nearing the top end of the trading range here, so you might want to take a little bit off. But if you need to hold for tax reasons, it'd probably be okay.
Yeah. Steve Grasso, where are you finding value in this space still?
So what's interesting is that if you go back 5 years, the XLE is basically flat. If you pick a stock, you have a better chance of that stock being flat. So if you go back to 2016, that stock is probably at the same level it was back then as it is today. So there's been a lot of chopping of wood. But when BK said an underinvestment in fossil fuels, I took out my decoder ring. And that, to me, is a political thing. He didn't mean it to be political. What it is, though, is that this administration has made a bet that we're going to be at alternatives or renewables, however you slice it, however you want to word it, quicker than we are going to be. The best performer in this environment has been coal. Can you imagine Biden coming into office saying that the stocks that are going to rally are coal and fossil fuels? No way. This is definitely something that's not changing and has caught the market way off sides here, and I think it can continue just because of the politics of it.
Yeah, I mean, Tim brought up the term the other day, and Pete, I believe you're on this show, and he said greenflation. You know, this notion that as we push to renewables, that the prices of the other fossil fuels go up very sharply, and that's exactly what we saw. Is that still where you want to be at this point? I mean, a name like a Peabody. When was the last time we talked about Peabody outside of this week, you know, years ago?
Right. Well, sure. I would say this, Mel. I think that, as I said, I think either this week or the week before, you asked me something about oil, and I said, I actually think it can go to 100 before the end of the year. And I still believe that. I think that the run that we have had, it's been going on now for nearly a year. It started right at the beginning of November last year, 2020, and it's been running ever since. And I'll tell you what, these beta names are absolutely exploding to the upside. If you just take a look at any of those names that have a 2, a 3, a 3.5 beta, like Diamondback and Rig and Devon and Occidental and Apache and all those various names, I tell you, Mel, you look at the XOP, which has a lot of those names in it in terms of an ETF, you will find yourself looking at something that looks absolutely extraordinary, and they just keep coming for it. We had 2 separate occasions today where the XLE had some very, very large option paper. As a matter of fact, to close out the day today, at the very end of the day, They bought 49,000 upside calls in the XLE. So we continue to see this day after day after day. All the option activity continues to signal to me that it's going to continue to go higher. I believe it, and I keep holding on. It is by far my biggest sector holding right now.
So here's a question for you, BK. FANG, the big cap tech stocks, or FANG, the stock, to the end of the year, which is a better place?
Oh, great question. FANG the stock, without a doubt. Yeah, I mean, and here's why. If you think that oil prices are going up, that implies that inflation expectations are likely to go higher, which then means that rates are likely to go higher, which is not good for those tech stocks. And I'd much rather be in the oil sector. And a lot of this, too, I mean, Tim is right about this greenflation. It's a lot of, think about what's going on with ESG. ExxonMobil, the big companies are returning capital shareholders rather than investing. And that is continuing as we speak. And I do think that's going to increase rates ultimately, which will hurt your FANG stocks.
Same question to you, Grasso. What do you say?
Oh, I go with FANG stocks too. But wait, let me hedge that a little bit. I think the FANG and the FANG can go. Yeah, I think FANG. It's an E&P company. It's up 127% year to date. It's in nosebleed territory. But I do believe when you look at FANG, the tech group, those are considered value amongst growth stocks. So I think they both can go up. I think the velocity on the chart I'm looking at with FANG, $109, the E&P company, I think that one's nosebleed. President Biden's going to do whatever he can to stop drilling, to stop production. These companies are not making the investment as a workaround. They want to hold back on their money, to BK's point on ExxonMobil, return money to shareholders until the smoke clears.
Here's a question in terms of the impact on corporations and the consumer, Nadine. At what point do we have to start factoring into EPS, into margins, $100 oil? I mean, everybody here seems to believe that oil prices are going higher, energy prices are going higher. That's great if you're in that trade. Not so great if you're a company who depends on those inputs. If you're a company that depends on consumers spending and not having to pare back on their spending because of higher prices at the pump or heating oil or whatever it is.
Mel, and I think you're making a really great point. And before I was talking about the short term. In the intermediate term, we actually see macro factors changing. And so you're going to see a rollover of the growth of GDP. So you're going to get to either an inflationary environment, so growth is going like this and inflation's still going like this or staying at a high level, or a deflationary, where both are decelerating just because of high comps. And what happens there is, you're exactly right, whether it's energy or the price of cotton or food at the store, all of those things factor into people's pocketbooks. In addition to the numbers we saw today from employment, you see people aren't coming back into the labor force. So it means that they're going to be drawing on their savings. So even though we had those huge savings numbers out there, for less than the 1%, people are going to start spending that down, and that will impact growth. So I think you're making a great point. It's just not today.